Good evening and welcome. I'm Anuj Mehrotra, Dean of the George Washington University School of Business. And I can tell you it's great to be back in New York and to be with so many alumni who are here tonight. I also want to welcome everybody who's joining us tonight virtually to this special edition of George Talks Business. Tonight we are pleased to present a panel discussion featuring our outstanding alumni who are leaders in the New York real estate community. Our moderator here tonight is Charlie Bendit, co-CEO of Taconic Partners and a member of the GW Board of Trustees. Charlie, thank you for co-moderating tonight. Our panelists are all members of the Center for Real Estate and Urban Analysis, or CRUA, Advisory Board. Jonathan Iger, CEO of Sage Realty. Evan Perisser, Senior Managing Director of Capital Markets at JLL. And Josh Kuriloff, Executive Vice Chairman of Cushman Wakefield. Josh also serves on the School of Business Board of Advisors. CRUA is among the most active centers at the School of Business and is working hard to broaden the opportunities for our students by providing outstanding experiential opportunities both inside and outside the classroom. Our undergraduate real estate program has seen tremendous growth in the 5 years since we began offering a concentration in real estate. We now have more than 100 students in the program. I would like to especially thank Charlie Bendit for making a transformative gifts to CRUA, including spearheading a campaign with a goal of raising at least $1 million by the end of our current fiscal year and another $1 million subsequent to that. Reaching or hopefully exceeding that goal will help CRUA to continue to provide only at GW experiences for our students, including treks to visit alumni and others, technical training and engagement with terrific alumni like those of you in this room and on the web tonight. CRUA's Executive Director, Rob Valero, is here tonight as well, and he would love to speak to many of you about CRUA's initiatives and how you can help. With that, live from New York, it's George Talks Business. Handing it over to you.
Thank you, Anuj. I want to let you know that we'll be passing the hat afterwards. I hope you'll all donate and help support CRUA. And those of you online, you can text message. I think, don't we have a text message facility here?
Happy to make sure that.
Okay, all right. Well, thank you all for coming. And in particular, I'd like to thank John, Evan, and Josh for being here and agreeing to share with us some of their thoughts about the real estate market in New York City today. Just by way of a little bit of a further introduction, we'll start with Josh on my far left. Josh and I have known each other for a very long time. We've both been in the real estate business in New York. He for 35 years, me for like 40 years in New York City. I have the great pleasure of working with him right now on our project on Essex Crossing. But he's probably one of the foremost leasing agents in all of New York City, representing both top landlords and some of the biggest tenants in New York City. Next, two persons to my left is Evan Perisser. I've known Evan for since 1976 when I met his brother, who is now my business partner. And he has been working with me on transactions ever since 1993 when I left Jones Lang and went on my own. And Evan has been working with me ever since in helping us to finance debt, construction loans, permanent loans on a variety of projects, the most recent of which was a $335 million construction loan on a life science project on West End Avenue. And to my left is John Iger, who is the CEO of Sage Realty. Now, I haven't known John that long, but I go back to the early 1980s when I was doing business with his grandfathers. I know, it really dates me. The William Kaufman organization, Bob and Mel Kaufman. And John has succeeded them and is now running their 3 million square foot portfolio here in New York City. So let's dive in, because I think you'd be more interested in hearing about what's going on in the market than hearing more bios of the three gentlemen to my left. So I'll start with Josh. Josh, From a macro point of view, what is the state of the commercial market? We hear all sorts of facts. Some of them are not all the facts. For example, we hear about the occupancy levels. And the occupancy levels have gone from 10% to 25% to now 46%. But that's only measured by one metric. And there's a lot of other information that's not in those metrics. What do you see about, number one, occupancy and tenants' demand for space from a macro point of view? What do you see is going on in the marketplace today?
Thanks, Charlie. Let me start with the bad news, which is due to the pandemic, we have the highest vacancy rate in Manhattan that we've ever witnessed. But it's really a tale of two cities. Just to give you perspective, Class B and Class C real estate, the vacancy rate is 25%. Class A space, think of Class A office space as 1980s buildings on Park Avenue, on 6th Avenue, beautiful buildings. The vacancy rate there is 19%, still extraordinarily high. However, new construction and highly renovated assets are half that, so roughly 9%. So it's really a tale of two cities. There's a complete flight to quality, and that flight to quality, by the way, is happening globally. And obviously it's due to the pandemic. New construction, highly renovated assets have better building systems to deal with more fresh air, better HVAC systems, touchless technology, and of course, new construction has the benefit of being highly efficient with no columns. So it's the tale of two cities. In the last 30 days, there's been close to over 1 million square feet of major leases signed. So we are making headway. And by the way, all blue chip companies, KPMG, D.E. Shaw, and Franklin Templeton, and all 300,000, 400,000, 500,000 square foot transactions. So again, on a positive note, we're also seeing, we're witnessing a 65% increase in leasing activity through September as compared to the prior September. So if I had to summarize, if we were an 8-cylinder vehicle on real estate market, we're right now running on 6 cylinders. So room to go. On occupancy level, we're now above 60% is from what I hear. And the elephant in the room is it going to get back to 80% in the next few years or not?
Are tenants shrinking their footprint?
So that everybody's been asking that question. And I think the answer is that roughly what we're now seeing is companies or corporate occupiers are trading up and willing to pay higher rents for the best real estate, and this is again globally, but they are reducing their footprint by about 15 to 20%.
Well, from my perspective, we have 3 office buildings. We have some life science projects, but that's a whole different sector. We have a building on Broadway and 12th Street, which was an older building, which we fully renovated. And during COVID, we did one deal in the 60s. We did a few deals in the 80s, and now we're up over $110 a foot. Because it's a great building and a great location, but what we did is we gutted it, renovated it, and brought in all new systems. So it's being treated as a new building. And then we have a building on 35th and 9th Avenue, tale of a different story. That building we were hoping to get 70s. Maybe we'll get 50s or 60s if we're lucky, and that's going to require a huge investment. And then we have Essex Crossing on the Lower East Side. That's a brand new building, and Josh is going to get that all leased up for us in the next month or two.
I will have a lease for you in the next 60 days on your desk.
All right. John, from your perch, where are you seeing things? You own properties in Midtown, you own properties in downtown, you own property in the meatpacking district, which we would have loved to have bought from you. What are you seeing from your perspective?
To echo Josh, it's a tale of two cities. The one thing that I would add, though, is who's the operator, reputation, along with what is defined as Class A. So We have a property, 437 Madison Avenue. Only 4 or 5 years ago, we reinvested in that property just north of $65 million to effectively lease up 900,000 square feet over a 7-year period, which we successfully did. And yet, in order to stay competitive in the market, we started planning even before COVID how to further amenitize that property and how to actually change how we operate the property, not just in base building systems, but the level of services that we can provide to our customers. And so, as Josh said, along with 9% is brand new construction. That's a 900,000 square foot property, and I'm at 4% vacancy.
Must be because of your reputation.
I do think that's part of it, but how you operate. Definitely not my reputation, but Sage's. We have another property on 3rd Avenue, and what we've historically seen in down markets, whether it's a recession or something like we're going through right now. 3rd Avenue, financial district, particularly the eastern side of the financial district, which unfortunately we also own a property down there at 77 Water Street. Those properties are typically looked at for bargain hunters, and so those properties do very well, after a strong bull run, as we saw particularly on the eastern side of the financial district, where companies like JustWorks and Hugo Boss got priced out of Midtown South and had to come down, and all that started to raise rents down there. And in fact, from post 9/11 till 2000. Or really 2010, from the Great Recession to 2016, I think that had the highest annual increase in rents. But those become the most difficult markets today, as Josh had highlighted, because of the vintage of the properties, slab to slab ceiling heights. So no matter how much you invest in those properties, if you can get a better product for $2 more, $3 more, or even the same price, because landlords can only drop their rents so much, you're going to have a difficult time. But while that's indicative of the overall submarkets, for us, we've always seen and we've always believed, dating back to my grandfather, that each property is a market into itself. So I think 437 Madison is an outlier for the Plaza District for a property that was built in 1963. We have a property, 777 3rd Avenue, that we're also 92% occupied. And doing deals at effectively a 6% discount to what we were doing in January of 2020.
Well, that's pretty good, because 3rd Avenue has gotten hit pretty hard.
And unfortunately, we have 2 other properties there, and one that we are putting a significant amount of money into at 767 3rd, and it's a boutique floor plate building, so we think it will lend itself well to boutique financial firms, smaller financial firms who can take their own full floor, and we're, again, programming and amenitizing the property for a specific customer, where I think in the past we've had much more of a shotgun approach as an industry, and really defining how can we operate this property, how can we bring services to our customers outside of their 4 walls to help support them come back into the office.
Well, I remember 767 3rd Avenue. That was a joint venture between Howard Ronson, JMB Realty, and your organization.
Our family, yeah.
But that building is a very small floor plate. I don't know what your occupancy is there, but if that was to suffer a large vacancy, would that be a building worthy of consideration for conversion?
So we are these days effectively strictly commercial, but for every asset that we own or that we have owned in the past that we've now disposed of, we look for highest and best use. So before we made the determination to do a office reposition, we looked at 767 because the way that, as you boutique building, brick facade, the way that the lobby lays out, we probably get 2 or 3 inquiries a month pre-COVID for apartment rentals in that building. So we looked at hotel, we underwrote for hotel, working actually with a team from Cushman. We looked at a conversion. The problem is around today's zoning. And it's a 300,000 square foot building. It was built in 80-81. And with the zoning restrictions for conversion and what the FAR is for residential, we would be able to convert that to a 150,000 square foot residential building. And I think that's one of the cruxes of the issues that we face today and will continue to face. I equate the overall market a little bit similar to something that you three lived much more than I did, but post 9/11 financial district, where we saw north of 30%, and if you took really sublet space, we could have been north of 50% down there. It took public-private partnership, and it took a long time for the neighborhood to rebound, and it rebounded and came back stronger and better than ever, and it's 24/7, 365, live, work, play now down there. In order for the eastern side, the financial district, to realize that, in order for our CBD in Midtown to realize that, we're going to need that public-private partnership where it would have been a much easier decision. Now, I had already made that commitment, but if I was sitting here today and I could convert that to 300,000 square feet, we would not be talking about that as an office building.
Yeah, I think there needs to be a lot more pain because we're looking at it on our 35th Street and 9th Avenue building, looking at the conversion. But when you think about the infrastructure costs that is needed in order to make the conversion, and then you go from an office rentable with a 28, 27, 29% loss factor to a net rentable residential, you lose about 30% of your space or something like that. So Evan, we haven't forgotten about you.
I've got the hot topic, which is the price of money.
Well, that, and what are lenders? Are you doing any equity joint ventures?
We are doing equity joint ventures, and they will become more popular as values subside, as they have. I'll take you back, and I brought a cheat sheet, Charlie, because it's important to remember. Actually, we don't remember.
Can't remember those 4,700
No, I'm going
numbers?
to tell you. We track. So there's certain indexes we look at what the cost of money, and one is SOFR, 1 month SOFR, and 1 month SOFR a year ago was 3.4% lower. Today it was basically zero. A year ago, it's like gone from 0 to 3.5. Treasuries have gone up 2.4% over the last year on the 10 and 3% on the 5. So in the last year, we've skyrocketed the cost of money, and we've put a shock into the system. And the subject of the day is, what's money cost? So we're getting fixed rate money at best in the 6s, and floating rate money even slightly higher than that. We look at forward curves, the forward SOFR curve. SOFR today is 3.25, and that's the index we use for floating. And the forward curve in the first quarter of next year has it going to 4.5 into the 5s. So if you're sitting on, and it's been right. So if you're sitting on floating rate money, it's going to get more expensive. The forward curve on fixed rate money is generally flat. 10-year is at 4% today, and it's supposed to be generally flat. The expectation. What's going to happen is anybody's guess.
And what are lenders thinking about the different markets in New York City? What are equity investors thinking about in terms of, do I want to buy? Do I want to invest in New York City? Do I want to invest in office? Do I want to invest in residential? We'll come back to life science because that's a whole different sector. But what is the capital saying about investing in New York City? Putting aside, of course,
I'll speak to the debt markets first. The lending community is cautious. Office buildings are not a favored product type. Every lender has a lot of office on their books. They're hearing statistics about vacancies that are 19 to 25%. So a well-leased office building is financed. We did a financing just 8 weeks ago on an office building at 36th and 7th Avenue. The building is 88% leased, and it had we quote a debt yield. So a $100 million loan had an $8.8 million NOI. That's an 8.8 debt yield. That's a healthy building. Mm-hmm. The $100 million loan was priced at that time. The 10-year Treasury was 3, and the spread was 3, so we got 6% money. That's 8 weeks ago. The 10-year Treasury is now 4. And that rate would be 7 if it was today. That was 10-year interest-only money. Family owns the building for 40 years. They were scratching themselves when they had to take 6% money. We're celebrating on Thursday night at closing dinner. They're delighted they got 6%, 10-year interest only, because the rate would have been 7 today. So capital's available. CMBS wants to lend. Certain debt funds will be providing money. Our friends at MSD Capital said the highest risk-rated return in the lending market is for office, but then again, they're charging 500, 550 over.
Well, we're just in the process of trying to organize a construction loan for a speculative office building. And we went out to the market. We had 2 lenders. One of the lenders said they would do it on their book, and the other one said that they would have to find a senior lender. We decided to go with the lender that said that they would do it on their book.
Better.
Right, better, less risk. They then came back to us and said, remember I told you that we were going to do it on our book? Well, we can't do that anymore. So now they're bringing in a participant. They went from 500 over to 675 over. And our debt service went from when we started underwriting the project from 5.5% to 11%. Wow. Our interest costs went up $60 million for our project. So that would spell trouble, but we haven't closed yet. And we haven't put any money at risk yet. So there's probably an opportunity to renegotiate. But I think that's what's happening. We have an apartment building that we refinanced about 15 months ago. I think it was 15 months ago. And we had the opportunity to lock a rate of 2 3/4% for 3-year money. And our partner, who owns 90% and we own 10%, and said, no, I like flexibility, let's go floating. So our debt service went from $3.5 million to $7 million. Wiped out all of our cash flow. So thank you very much to our institutional partner. What are you finding, John? Have you been in the financing markets at all lately?
We have. I have a similar story with a institutional partner.
Darn those institutions.
We were, after changing our business plan around them.
You floated.
Worse. We had a phenomenal lender lined up due to our long-term relationship in New York City. There was minimal risk, there was recourse, but again, the way that the tranches were being structured, we would have never realized it. And our institutional partner did not want to pull the trigger. That was 2 1/4. There was going to be a LIBOR or SOFR ceiling. It would have ended up costing us another $2.5 million to buy the cap, which would be tracked once, the never realized debt that was put on. And we would have been capped out at sub 4% money, basically, on a $125 million reposition loan. Their investment committee killed the entire reposition, pulled back on the finance. We re-entered the market 3 months later. That lender offered us, again, this is now March of 22. That same lender was looking for greater recourse and was pricing at 4.5% at that time. We went with a different lender. We ended up with Acor, which we're very happy about. But we are north of 5.5%. So I could have been sub 4. We're at 5.5, and a piece of it has to stay floating. So our exposure is greater. I think what's more indicative of the market is we went out to finance 777 3rd Avenue. And again, this is a building that is 92, 93% leased. We have a track record during COVID of being able to lease up spaces 3,000 to 6,000 square feet, which make up the majority of our tower. We have minimal roll over the next couple of years. I've got just under 7-year WALT on the property. And for the amount we're going, however, whatever cap rate you want to place on it, realistically, this is sub 50% LTV, any way you want to slice and dice it in today's valuations. 33 lenders we went to, and since I'm still negotiating the loan, let's just say the appetite was de minimis. The lenders that were on tour, due to existing relationships, many of them said that their balance sheet is closed for the rest of the year for commercial office, and particularly commercial office in New York. Most people who would normally tour never even came on the tour. So just the overall appetite, and particularly on balance sheet lending for these assets. And again, it's not Class A Hudson yards, but if you're going to lend, like a Taconic, like a Sage, long-term reputational operators in New York that can show not just a history, but a history during this market of successful leasing, like you guys at 817 Broadway and other properties, us at 437, 777 to Gansevoort, and you can't even speak to someone. I think that's indicative of the market we're in. To us, it's much scarier than even 6 months into COVID.
Wow.
And that's date stamp that. Give me the timeline of that. That's current right now?
That was, no, we have signed term sheet and negotiating loan doc, so that was end of Q1.
A different time.
Yeah.
And-
I can imagine what it's like now.
And
Worse or better?
It's worse. Well, how much are rates up since then?
Right.
And is it a portfolio lender or is it a CMBS execution?
Balance sheet, local relationship bank.
And you're doing a floating rate loan?
No, this will be fixed.
Okay.
Yep.
And you fix the rate?
Yes. So we fixed it at, and mind you, I've been waiting 15 years. We've had a 15-year loan on this property, 2007, at just over 6.5%. And every year I've been waiting, and like our institutional partners on GAAP basis, refused to handle the defeasance years ago when it was the right decision to be made. And we've been waiting, and 6 months ago I'm chomping at the bit. I'm coming in less than 100 bits from
And
what
the
I had
market
in
got ahead of you.
2007.
Well, we should put this into perspective because
Now you're going
we
to tell
had,
the story.
we had free money
Yes.
for a very long time. For like the last 3 or 4 or 5 years, we had free money. Capital was people treated capital with arrogance. It's 2%, 1% money. You could do better than that. Now all of a sudden, capital is king. And rates today are not that wildly different. Okay, right now when I'm talking about 11% construction financing, that's a little bit higher than what was normal. But if you look at a normalized market, Evan, what was a normalized
I'm gonna
market?
have folks do a little homework assignment. Get your Apple phones out and go.
You're not
to,
supposed to have Apple phones
well,
working
you
now.
can, on silent. Get your Apple phones out. Do it now or do it later. Get your Apple phones out and go to the stock account and track a stock called TNX. And TNX, Tom Nancy Xylophone, is the 10-year treasury. So put that in your phone, and then you can track what it was. You'll see it's close to 4%. And you can see 1 month, 3 months, 6 months, a year, 5 years, 10 years. Then the last button is all. All goes back to 1985. Yeah. And you'll see that the 10-year treasury was about 12% then. So to make it relative, there's the chart.
Right.
Rates are low today,
And you know
relative to the last 40 years.
And you know what else is interesting? If you look at cap rates, the movement in interest rates has had a small effect on cap rates. If you go back 5 or 6 years, cap rates for high quality office buildings were, maybe they were 4.75%, maybe they touched 5%. We have been underwriting exits of 4.5%. So it's not that different than what it was when interest rates were much higher. I think we're in a aberrational period of time. It will correct. I don't think we're going to see free money again for a while. I don't think interest rates are going to come down to 2% or 1% unless we go into a prolonged recessionary environment. I just can't see that happening.
Charlie, when I was a student at GW,
What century was that?
I'll confess, 1980 to 82, we had interest rates that were bumping up against 20%.
Right.
So I did a little homework today, and there was a tremendous inflationary period at that time, more so than we're having now. And the Fed, which is very powerful, went to bat and worked against that. I think prime hit 16% then.
Higher.
Prime. And certain indexes went to 20. money markets were yielding 16% then. Your father or grandfather were buying New York City office buildings at 10 caps
We built 767 Third Avenue in that market.
at, well, cheaper cost of capital and to higher returns.
Oh, yeah. I mean, I was buying, when we were doing apartment buildings in the 70s, you were buying 10 after a 10% contingency. So, but interest rates were much higher. John, you mentioned Hudson Yards. Josh, talk to us about the movement to Hudson Yards. Who would have thought that 11th Avenue, 10th Avenue, 9th Avenue, the West Side Highway would be an established office market? And yet what we have seen is a huge migration from the established office market, tenants moving out of 80s vintage buildings, much less 60s or 70s vintage buildings, to Hudson Yards, to Manhattan West, of course, One Vanderbilt, which is in the middle of everything. But talk to us about what's driving that. Obviously, they're newer buildings. And do you think at the end of the day, in 5 years, 10 years, or 15 years, when those leases expire, tenants are going to say, what are we doing over here?
Well, first of all, I wouldn't take my advice because when Related was planning on building...
You're my leasing agent. What do you mean, don't take your advice?
When Related was planning on building Hudson Yards, I said, these guys are crazy. Nobody's going to want to go to the far west side. And 16 million square feet later, it developed pretty quickly. So I think the thesis on Hudson Yards was, let's start with what John said earlier, public-private partnership. They put in a small train station, cost over $2 billion to connect Grand Central Terminal to Hudson Yards, a 7 train. That was a game changer. Without that 7 train, Hudson Yards would not be where it is today. But the developers had the foresight to master plan these projects. Very rare to get a swath of land in Manhattan like both Brookfield and Related were able to get. And they master plan projects, and it's mixed use, it's live, work, play, it's outdoor space, it's food and beverage, it's event space. They've created an ecosystem there. Lots of retail, and now some of it's hard to get into the restaurants in Hudson Yards. So, and then, as I said earlier, we represent Brookfield at Manhattan West, where we successfully leased over 5 million square feet over the last few years. And our first anchor tenant was Skadden to kick off One Manhattan West. And we did a study with Gensler. For those of you who don't know, they're one of the largest architectural firms in the world. And we took a 1980s vintage building and compared it to new construction. Same exact workplace. So no change in office sizes or anything like that. And Gensler their study came up with new construction, effectively, you could take 15 to 20% less square footage than in 1980s vintage building. So at the time, Skadden's study was that they could stay where they were, but they'd have to lease 15 or 20% more square footage, pay a higher rent, go to new construction. And so new construction just has the bells and whistles, there's no question about it. But it was the master planning, public-private partnership, and creating, there's 2 great ecosystems over there now. There's the Brookfield Manhattan West ecosystem and the Related Hudson Yards ecosystem.
Well, speaking about ecosystems, we're developing a project on the Lower East Side called Essex Crossing. And Josh represents Verizon and went through a process to look at opportunities to move their marketing group. Why don't you tell us a little bit about the process they went through and why they chose to come to Essex Crossing? Because it represents or is emblematic of what tenants are doing and the thought process that is going into the types of moves that they're considering and why they make these moves.
So full disclosure, if I don't say great things about Essex Crossing, Charlie will fire me tonight. But on a serious note, Taconic created an ecosystem with Essex Crossing, one of the largest market food hall in Manhattan, mixed use, amenities, outdoor space, And for Verizon, it was a very interesting study because we actually thought they would go to Hudson Yards, new construction. And they view themselves as a technology company today. And they actually fell in love with Essex Crossing. First of all, it's the antithesis of Hudson Yards. So it's, for those of you who don't know the Lower East Side, it's gritty. It's very cool. There's a great demographic down there, probably one of the hottest residential markets in Manhattan. And then we checked the box of new construction. We checked the box for Verizon of great amenities. We also studied their labor force and the connectivity to Brooklyn, and the labor pool coming from Brooklyn was the best labor pool for them to recruit and retain talent. So again, reputation of building a master planned ecosystem and workforce attributes and the ability to recruit and retain talent was a key driver for them. And they actually they did not want to be in Hudson Yards because it's glass and steel office buildings, and it's a different market, completely different market.
Yeah. So what do you think is going on in Midtown? So there has been a shift. Tenants are looking for the types of amenities that maybe Midtown doesn't have to offer. They don't have the outdoor space. They don't have what Hudson Yards or Manhattan West had to offer. What do you think Midtown has to do to retain tenants and actually maintain rental levels? What do you think needs to be done? Or is it just fine the way it is?
Definitely not fine the way it is. Look, I think being able to master plan like you were able to at Essex Crossing, Manhattan West, Hudson Yards, those are once in a lifetime unique opportunities. So it doesn't land on one or multiple, developers in a partnership. And so where I think the opportunity lies is less directly in the neighborhood and more on a building by building asset. And so because of that, you're going to attract a different type of tenancy, right? I'm not in the running for Verizon. But what we forget sometimes is that the global office market, the majority is made up of small and mid-sized companies, not the enterprise. The enterprise makes our jobs much easier. And that's reflective of our 3 million square foot portfolio. We have a number of Global 400 and Fortune 500 companies that help anchor a number of our buildings. But the majority of our tenants, of which we have 280 today, I believe, are small and mid-size. And so Hudson Yards and Manhattan West and even Essex Crossing and others, if that product's even being offered for 5, 10, 15, even 20,000 square feet at times, it doesn't always fit their needs the same way that Verizon was looking for something specific. And so since that's a limited offering, I think it starts to land more down onto the building level. And then that goes back to what does the building provide? And so when we can, for all of our properties, we do have usable private outdoor space. We are fully amenitizing physically our properties to best support, again, live, work, play. And if you're Verizon, you're looking at, or IBM and other companies, you're of course looking at what does the overall neighborhood provide, what does the building or the complex provide. If you're a smaller tenant, right, and you can't even put the resources that these companies can within their own space, right, particularly if they're looking at even downsizing today, which for our small and mid-sized companies, they are not. Larger, yes. Then they are looking to the property owner, the property manager, in how does the building become an extension of their own space? How do they take 4,000 or 5,000 square foot with you, but be able to offer so much more to their own employees? And so that's what we focus on, whether that's around physical amenities or service amenities, or simply a new concept that we soft launched just a couple months ago, I think making the announcement in a couple weeks, so you guys will hear it first. The concept of a campus. So our 6 properties, if you are a customer, a tenant at 77 Water Street, your building ID access today works at the 5 other properties. And whether that's simply to access soft seating in the lobby or to access an Oasis amenity space of ours or a wellness component, you have access of that today.
Interesting.
Well, let's talk about amenities. I've been hearing that the big companies like Google and Facebook, not only are they cutting back on the number of employees they have, but they're also a lot of those freebies that they used to make available to their employees, they're even cutting back on them. How do you think that's going to change the types of amenities that building owners might be offering their tenants going forward? Do you think it'll change at all? I agree with you, by the way, John, that providing conference facilities so that tenants could better utilize their own space and use it more efficiently, that makes sense. But have we gone overboard in trying to provide a lifestyle experience for office tenants when now tenants are beginning to think about things a little bit differently, or are they?
Well, Charlie, we did 2 transactions I'll point out in the last year that for small floor plate office buildings that meet the specs you talked about, which were flight to quality, best in class space, high rent space. One was on 57th Street, Charlie, for the Alchemy Group, Ken Horn. Mm-hmm. They just demolished the Salisbury Hotel, and now they're gonna go up with a 140,000 square foot office building over a brand new church. And the second was at 43rd and 5th for the Rabiner organization. In March, we closed the $550 million construction loan. That'll be office over retail, and then high-end condos up top in a super tall of 1,000 feet. But the amenity package there is a private members club to be delivered at the 2 lower level floors and at the grade floor, which will be, I can't wait to go there. It'll be a super amenity, and it'll compete with the best private member clubs in the city. So they're still throwing amenity packages at best-in-class buildings, and certainly in the newer buildings.
What do you think, Josh?
Well, I think a client of mine a few years ago said that the office market is going to shift to the hospitality business. And I think that's where we're heading. I think the casual environment of being in a Four Seasons hotel and having all these amenities on call or on demand, I think is the future of office buildings. So I still believe that the amenities and curated properly will draw corporate occupiers to real estate today. I can tell you when we have a scorecard when we go on tours with a scorecard for our corporate occupier clients, amenities is on the list, as is now sustainability, things that were not on the list 5 years ago.
Well, I'll tell you a little bit about the residential business, because I don't know that you can speak to the residential business.
Not anymore.
Josh, not sure you can, but Evan, can you talk a little bit about the residential market in terms of cap rates, in terms of financeability?
So a good client of mine who was getting among the highest rents for multifamily rental in the Lower East Side on a building I arranged the permanent debt for.
Is that us?
You're right there. You're not as high as him. You're very close. Right. You're not as high. He's a little more of a boutique-y building. You're very close. He said that the last 2 months rents have softened a little bit, right?
Yes, that's
and you opine to that.
Well, we before COVID, we have an apartment building on 52nd Street between 10th and 11th. We have about 2,000 units in the Bronx, which is more or less affordable housing. We have several thousand units in Manhattan, although we own and manage 392 units. The rest Related manages one. They're a partner of ours in the Caledonia. And our partner, L&M, manages the buildings at Essex Crossing. And we follow what's going on. When COVID hit, Related didn't want to drop rents, and our occupancy went from 98 to 77. We on 52nd Street decided that a lost month of rent is hard to replace, so we dropped rents. And our occupancy went from 98% to about 88%. Since then, are related at Caledonia went from 77% to 99%, and now we're back up to the high 90s in average rents. On 52nd Street, we're getting the highest rent we've ever gotten, and down at Essex Crossing, we're getting rents in the mid-90s. It's quite expensive, but you're right. What we have found in the last month or so is that our concessions have gone up from about a week to about a month. But part of that could be that there's enough sticker shock out there. Rents are that high, but it's also going into the slow season for rents.
Seasonal, yeah.
It's seasonal. Right. So we're going into the slow season. I asked our asset manager, well, what do you attribute it to? And he said it's probably mostly seasonal, but there's a little bit of sticker shock out there.
But that's not to say the Manhattan rental market is tremendously strong.
Well, there's nothing. We're building a building on 43rd Street now. It's 330 apartments. We'll be delivering in mid and early 24. There's very little product because the rent the real estate tax abatement expired, and there's no new product coming on strong. So I think we're in a pretty good shape. One other subject that I'll touch on briefly, and then we'll open it up for questions, is the life science sector, because it's been getting a lot of publicity lately. We owned a building on 54th Street between 11th and 12th Avenues, and we thought it was a good play to provide a lower cost alternative to the far west side. Hudson Yards was getting big rents. We underwrote rents that were half of what they were getting, and we thought it was a good play. We were approached by the New York Stem Cell Research Foundation. They took 40,000 square feet, and we said, we must be onto something here. And so we looked more into the life science sector and found that there was a huge shortage of supply of that type of space for an emerging market. New York City has the second largest amount of funds from the NIH in the country, and yet we have the smallest amount of space devoted to life science. So we began a process of converting that building to a life science building. We're now about 95% leased, and we bought a building from Silverstein, who had bought it from ABC, to redevelop a building on West End Avenue of 400,000 feet. And leasing activity is going very well there. We have another building on 94th Street between 2nd Avenue and 1st Avenue, and we're going to be developing another building down around NYU's hospital. So we'll have about 2 million square feet of buildings devoted to life science, and it's a sector that's getting a lot of attention, not only by developers. We're now the second largest developer of life science projects in New York City, but of venture capitalists, and of course, of tenants that are being backed by the venture capitalists. And if you listen to some of the venture capital pundits, they'll say that one of the areas that's of most interest is investing in life science. And a lot of it is around immunotherapy, of ways to treat cancer, and there's a lot of research around that area as well. So those are, I think we've touched on 3 sectors. We didn't quite touch on retail, we didn't quite touch on industrial or on hotels, but if you want to come back next week, right, Anuj, we have another session. But I wanted to open it up to questions from the audience here. I don't know if anybody, yeah. You want to tell us your name?
My name is Craig Rahm. I'm with Helmsley Spear. I had a question. Like several of you, I work in commercial real estate brokerage, and the circumstances regarding landlords and obtaining financing and some of the issues you're going to, we've been discussing internally, and maybe you have some thoughts as well about, as a separate or different source, instead of conventional lending, which obviously is becoming more expensive and problematic, going to tenants. Obviously not all, but in this particular market, there's more than a few who have the capacity to buy in a minority share of buildings that they're occupying or considering occupying. And I just wanted to see if any of you had any thoughts on that, particularly if many of you own or represent owners as well, and what your thoughts on might that be.
Well, I'll tell you, if you get a good credit-worthy tenant, you don't need their ownership in order to finance it. I mean, we have Verizon on a 20-year lease that makes it very financeable. It's a little more difficult. You would think it would be a little bit more difficult if you had smaller tenants making up your entire roster of tenants in a building, but I would argue that that's a pretty secure tenant stream, cash flow stream, particularly if you have your lease expirations over many, many years, not all at once. What do you think, John?
I think it's clever. I wouldn't do it, and I'd reach out to Evan, and he'll find you better solutions.
I'm sitting here reflecting on it, and it's a reverse sale leaseback.
Yeah,
right.
That's why I said it's clever. I mean, look, the first thing that you're telling your customer is, you either are in financial trouble, or you might feel that way, or how that's going to be perceived. So I'd say that's the first part. The second is you're effectively, what are they actually buying into, right? Because as Charlie just alluded to, we get to borrow money effectively on other companies' credit. And so they're going to buy into the building, and then they're going to vacate. And how are you going to negotiate with them 5 years from now when their lease is up, but they also have a piece of equity that it gets very.
Part of the issue might be tenants want to always preserve the flexibility that they secure through a lease, and they really want to have the real estate off their books and not be a liability on their books. That's why you see sale leasebacks.
Commercial condominiums never really succeeded in New York. I think mainly because of flexibility, and tenants don't want to be in the real estate business. They want to operate their business, and that's just my experience.
Unless you're Google.
Yes.
Yeah, you had a question?
Or Amazon.
Yes. So I have two. One is I've watched this building occupied by Verizon down by all our bridges turn from a windowless tower into partially glass and steel. So I'd like to know what's going on with it. It looks very impressive. And then north of, along 125th Street and uptown, because we've been talking about Midtown and down tonight, what's going on along 125th and in uptown Manhattan?
Well, I guess you know that we're developing a building there as well on 125th Street. Well, we are. We have a project that was the National Urban League won an RFP. That was a state and city RFP to develop a site next to the state office building. I think it's just between Frederick Douglass and Adam Clayton Powell Boulevards. Unless they change the facade on me. But it's... Yeah, it's a new building coming up. The facade is just going on right now. We have 85,000 square feet of speculative office space. We have 80,000 square feet of retail, most of which has been leased to Trader Joe's and Target. And we have 170 apartments. National Urban League is moving their headquarters there, and they're developing a civil rights museum. So it's a truly a mixed-use building. And so we're feeling pretty good about the market there. It's a very tight market, and there's very little Class A space. So we've already been in discussions with tenants to take half of the office space. So we'll see what happens.
We actually looked at, also doesn't help not to follow Taconic. When they go in, they help basically invent meatpacking, and now we're landing 125th. So one of the first office buildings to come to market during COVID, Jamestown brought 1025 Park Avenue, I believe.
Yeah.
Which is effectively 125th and Park Avenue, and they did a decent job repositioning that asset for the money they put in. We felt the same way. We saw what Taconic was doing just a couple blocks away, and it's supply constrained. So you can remove a lot of the other components that we talked about. And one of our bets, less in Brooklyn and some other areas, so like we think that's going to take longer, but 125th is a major transportation hub. More of the workforce you're seeing is, yes, living in outer boroughs in Brooklyn, but in order to pay the rents that you were paying 10 years ago in Williamsburg, you're getting pushed out, and you're further beyond Gowanus at this point. And we have a lot of resi developer friends who've been very successful in that area, where those people are working at Bloomberg and other businesses Midtown. So we're very high in that area for those reasons, and that redevelopment and other components that are going on around 125th. It's just a supply constrained market. Unfortunately, we couldn't come to terms with Jamestown.
Charlie, before we conclude, I just would love to, two quotes I heard from two very senior people that I think particularly would be important for the younger generation to hear, and that is Tim Cook publicly stated that he does not believe the iPhone would have been invented on a Zoom call. And the second great quote that I heard was Jamie Dimon said, he's the CEO of JP Morgan Chase, said high achievers will be in the office. So I leave you with those two quotes.
Well, I was going to ask the question about what you think the future of remote work is, and I got to tell you, everybody is in our office, and they're in it because they like the work environment and they like the fact that they're collaborating with their colleagues in the office. And I think we went through a phase, and I think that phase will phase out. Before long, people will be back in the office 4 days a week. Maybe it won't be 5 days a week, but they'll be back in the office 4 days a week. I think the cane is pulling me off the stage. I think I'm going to hand it back to Anuj. Do we have time for one more question?
Sure, Charlie. How about one last question?
Jack All, Property Investment Group Services. First of all, thanks everyone for your information and insight. I think everyone's gotten a whole lot out of tonight. My question has to do with this. I guess it's coming out of the pandemic, although they say there's still some issues and so on. And you mentioned conversion to residential and so on, and hotel I understand. Okay, what about this big migration out of New York to Florida? You can't buy a place in Florida. There's nothing, especially now that the hurricane damaged the western side. Could you spend a minute or two talking about, are people moving back into New York? Who's all these people are going to live in these spaces that we're doing? And I think, Charlie, you may have answered the question on your last comment there. It's kind of going back the other way. Is that what's going on?
Well, apartment vacancy is 2%, 3%, 2 or 3%. So people are coming back to the city. Yes, there are people that are leaving. I actually have heard that people that left and went down to Florida and bought places, and they have young families, are coming back to New York because they can't find places to send their kids to school. So they're coming back to New York City. I think we can get into a long political discussion about the future of New York and how sustainable some of our programs are. But that would take us a couple of hours, and I'm sure as many people that are here will have different points of view. It would be a very lively discussion, I'm sure. I think that the out-migration has not been as significant as the press would lead you to believe.
I'll just add, I just saw a very interesting statistic this morning. We track office using employment because that's effectively demand for office space. And the stats came out this week, or last week, and right now, office using employment has just surpassed pre-pandemic levels. That said, I still don't know why people the streets are packed, the restaurants are packed, Yankee Stadium is packed, the Madison Square Garden is packed, but the office buildings aren't packed. So, we'll see what happens.
The demand for residential tells the story. Rents are at or near all-time highs, and vacancy is nil. Young people want to be in the city. We're getting bombarded with resumes at JLL, in New York. Our capital markets internship program hit a record. We opened our resume pool for 6 weeks and got 350 resumes for 12 spots.
How many GW people are you hiring?
We have one. And Valero's working me hard on another. Stay calm.
Right. By the way, Cushman Wakefield had 400 resumes.
Oh, there you go.
The only thing I would add to that, I'm a born and raised New Yorker. It's painful being on the stage with the Yankees potentially playing, so we'll get a score update after this. Everything that we've talked about, particularly on the office side, but also this all has to do about talent attraction, talent retention. Right? So for all the news that everyone's heard about people leaving New York and right, the companies that have opened up offices in Miami and Austin and other places that didn't have, the announcement is never we've closed our office in New York. Right? Citadel's main offices are still waiting to be opened at 425 Park.
Right.
Right? That's not the overall story. And again, not just because I'm a born and raised New Yorker, but all the companies, Verizon, all the companies that are utilizing space at Hudson Yards, Manhattan West, that have renewed at our own properties, it is about attracting and retaining their talent. And it's beneficial. They should have offices in Miami and Austin and Savannah and all these other amazing cities in America that cost of living's lower. You need to provide different options to create, and whether remote work is here to stay, some level of hybrid and particularly remote work across the country, outside of a property management company or something, is how you're going to be able to attain and retain best talent. But there's nothing like New York, right? Broadway, go to a baseball game, go to a museum, the experiential retail, that was first realized in meatpacking that has spread across New York. That's the fastest growing retail that we didn't touch on. I mean, it's, mini golf and pickleball in New York City now.
Right.
I'm literally negotiating with a pickleball company for office space. Like they're going to convert the office space into pickleball courts.
Yep.
So I think that's the story that gets missed, right? For every company that has opened up office, they are not relocating their offices. It is just an annex, and their home base, their headquarters, for the most part, is still New York.
Yep. Anuj?
All right, well, thank you very much. Please join me in thanking our panel for what was most informative, timely, and you can see they are just getting warmed up, so this could go on all night. But thank you all also for joining, and those of you who joined online as well. And please stay tuned to our website for the next George Talks Business. I'm just so glad we are here in New York tonight, and please continue to enjoy the reception following this. Thank you very much again.